A sea of red on the Dalal Street today, the sell-off continuing to a fifth session now. Sensex logging its biggest daily fall since November 2021, sinking over 1,500 points. Nifty also posting its worst day in 2 months, down 6% now in just the past 5 days. The Nifty declined over 460 points today. All sectoral indices in the red, with cuts in the range of 2 to 6%. Losses in IT, auto, metal, pharma, consumer shares, all pulling the headline indices lower. While all sectoral indices bled, stocks of new age tech companies were the worst hit. Paytm, Nykaa, Zomato all hitting new 52-week lows. With the carnage on the Dalal Street, investors have lost about 20 lakh crore rupees. So why did we witness this Monday mayhem on the Dalal Street? Nervous investors entered the pre-budget week low on confidence as they awaited the outcome of a 2-day Fed policy meet. Rising crude prices, geopolitical tension, ongoing FI selling, some of the reasons that are keeping the markets under pressure. Joining us now, our global business editor, Udayan Mukherjee. Udayan, what a day for the markets. In fact, what have we been seeing the last few days now? It's been a rapid sell-off. We're now in the negative for 2022, just when we thought, we'd kick-started the year on a really positive, upbeat note.
Abha, we were speaking about it last week. You will recall that I was saying that there's every possibility that a global bout of volatility will jolt us, and that was the risk really, not so much Omicron or the budget which we were discussing. And it's been global, this massive correction which has set in. It started actually with the Nasdaq a few weeks ago, and that was the first sign that the US market was waking up to the possibility that the Fed might have to be more aggressive and more urgent in interest rate hikes, and that's exactly what has happened. So, the Dow has corrected, but the correction in the expensive stocks or the fancy growth stocks in the Nasdaq has been absolutely brutal. So I think some of that is flowing across here. We've seen some FII outflows, but I think India will also be hurt by this round of global volatility. Now, how deep this becomes, we'll see in the next few days, because it also depends on how badly global markets do. But I think we've pulled up back from the brink of that 18,500, which was the previous peak for the Nifty, and we've come very quickly down to the 17,000 levels. Now, we still have a cushion of 500-600 points, because I think the last time the market fell to around 16,400 on thereabouts on the Nifty, and from there we saw that very smart 1,700-1,800 point rally. So we have some room to go back and test that level, and we are not hitting those bottoms immediately. But I think in the next few days, that's the level to keep watching, that broadly that 16,500 level, on whether the market manages to hold that and bounce back and stabilize from that. But I think we are in for a few rocky days. Rhythm, good to see you on the show again. It's quite a day to have you on. Do you think it's going to turn out to be one of those years where the union budget becomes a sideshow and all the attention is hogged by volatility in global markets?
Well, yeah, potentially it can be. I mean, we've been anticipating volatility around the Fed's exit, so it's come, and that's appropriate. It doesn't mean the bull market is over. We had a similar situation in 03-04 when the Fed exited, and there was a lot of volatility. This is not 2013. I think the 04-08 cycle, as we've discussed in the past, is more relevant to this one. But of course, we'll see. The budget, yeah, I think it can still bring relevant things to the table. India has got a fair bit of idiosyncratic factors that are going for it, and amongst them is a new profit cycle. So I would still be keenly watching the budget. I mean, it is never a sideshow. Its impact on the market, though, at least short-term performance, has been waning over the past 3 decades. And even the volatility on budget day, which used to be quite intense in the 90s and the first decade of this millennium, that also has reduced a fair bit. And maybe this is because budgets have evolved. It no longer has the ingredient of indirect taxes in it. Direct taxes are far more stable. The fine print has, kind of gone away. But the overall strategic thrust of the budget, I think, is still relevant. It's very relevant to how this bull market shapes up in the coming months.
We'll talk a lot about that, Rhythm, but first a little bit more about this global volatility. I mean, how intense do you expect it to be? Because the Fed seems to be ratcheting up its intensity and its urgency quite a bit in the last few pronouncements. Do you expect, I mean, a fair amount of fall has already happened in the high growth areas in the US, the expensive stocks, the technology stocks. But do you see much more ahead in the next few months?
See, I think, Udayan, I would be actually quite encouraged that the Fed has expressed this urgency, because the risk, one of the risks, and I think we discussed this on the previous show, one of the risks to the bull market was that the Fed fell behind inflation. Markets hate a Fed or a central bank that's behind inflation. It applies to the RBI as well. And the risk was that given the pandemic, central banks were taking less chances. They were being, erring on the side of dovishness, and inflation was, building up. So the fact that the Fed is a bit more urgent, aside from this volatility, is actually good news for the growth story ahead. And if the Fed, does keeps its nose ahead of inflation, the markets will actually like it eventually. This is, par for the course. We've been in an environment of very low interest rates for several quarters now. And if interest rates are going up, then as you very rightly point out, high growth stocks, which are trading at high multiples, are the ones that take it on the chin. The market is discriminating between those and the rest, where multiples may not be as rich. So the headline indices have not corrected as much as what has happened underneath. And I think that will probably remain the narrative for some time. And then you get some sort of capitulation, which I think then causes indices to bottom out. So that could be the path ahead. We still need to see what the Fed does and how exactly it pans out, and how much market prices in before the Fed event.